Everyone was certainly surprised by the official inflation figures last month, which show prices fell in the March quarter, leading the RBA to cut rates last week. So why is that bad? Well, imagine you were in the market for a television, for example, costing $1,000. If that price falls to, say, $990, you're getting a good deal, right? But what if you notice that price continues to decline? Many consumers would postpone their decision to buy that TV because they'd expect even cheaper prices down the track. Now, if those price declines continues to happen across the economy, then shoppers would hold off on spending and stall overall growth. JP Morgan's Sally Old expects the official cash rate will be slashed from its current setting of 1.75%.
And we think that the RBA will take the cash rate to 1%. Probably won't happen until early 2017.
Weaker consumer prices have the potential to crimp growth.
Businesses postpone hiring decisions because they know that they can probably hire someone for less tomorrow than they can today.
Prices are falling because Australian products are generally seen as too expensive in a globalised environment.
So what we're seeing is what economists call margin compression. So that spread between what something costs the retailer and what they sell it for is actually starting to come down.
Low inflation, though, is an issue global central banks have been grappling with.
Japan, the US and the ECB in Europe have been throwing the absolute kitchen sink.
They've tried pumping money into their economies. Some have tried negative interest rates. It's not as dire here, with the RBA sending this message.
We're not that worried about the growth story. We're not that worried about the labour market, but we are worried about inflation. But guess what? We're going to do something to shore it up.
Leading more experts to rethink their rate strategy today.
Well, we now expect not only one interest rate cut this year, but potentially two over the course of 2016.
Cutting rates gives consumers more money to spend, shoring up inflation and the economy. Lower Australian interest rates mean a lower Australian dollar, with many economists predicting a fall to below 70 US cents.
So we're targeting 65 cents on the Aussie by the middle of next year.
At that rate, Australian exports become more competitive. And look at that Australian dollar right now, below 73 US cents, an 11-week low. The broader market also finished weaker, with the banks leading the declines. Westpac was the worst. Macquarie rose, resource stocks also fell. And that is the day in finance.